And that is why I will never talk to my uncle again, because the memories is just insane. And I always have to wear jeans in the shower. Welcome back to the Investor Shed podcast. My name is Nick Beveridge. I am here with a guest in the studio today. We've got Jeremy Kitchen over there. Go ahead.
Hey, testing everybody. How we doing? I'm sitting on the couch, shunned away. We got Brett Shoemaker in the house with us today. Brett, how you doing?
Hey, sorry I'm late. It's because I don't respect your time.
Oh,
we
thank
appreciate
you.
it. We don't respect yours either. That's why we had to do all these tests before we started.
We appreciate your honesty. Yeah. So, Brett, hey, thank you for coming. You know, it's late 2024. We're wrapping up the year. I would just love to talk about loans, wouldn't you?
Yeah, might as well. Who'd you guys vote for?
The loan guy?
I voted for RFK.
Okay.
How about you?
Who'd you vote for?
Donald J. Trump.
Nice.
Yeah.
Cool.
I'm in North Idaho.
I voted for Kamala P. Harris.
Okay. So we all voted for different people. There should be an interesting
name.
I wouldn't mind voting for Trump, but I just didn't want to hear about it in my household.
You know, that's probably why our listeners are down to 86% because we talked about politics on the show last month.
Oh, did you?
Yeah,
We did. We had a whole episode about politics.
we did. It was fun.
Yeah.
Brett, it's real estate's been weird lately. We just don't know what to predict, and a lot of shows lately are trying to do it, and then they're just wrong. We talk about interest rates, what our predictions are going to happen there, and then it just doesn't happen, or things happen that we don't expect, like rates suddenly come down quite a bit, and everyone gets excited, and then they don't refinance or get a loan, and then those magic interest rates go away, which just happened a couple months ago, right?
Yeah.
What is going on in the world of lending from your perspective, since you're a professional?
I mean, it's tied to the market, but largely when we talk about interest rates right now, it's fixed to the job market, and so the job market has, whether it's accurate or not, has continued to appear to be strong. And so that has a lot of downstream effects. But at the end of the day, investors, who are ultimately the people who determine indirectly interest rates, they're trying to predict. And what they're predicting right now is that the Fed is not going to lower the Fed funds rate as much as they maybe had previously anticipated. And so then that drives the 10-year Treasury bond up, which in turn drives mortgage rates up. But if you're trying to figure out, hey, where's the mortgage rate world going, all you have to do is look at the monthly jobs data. And
Okay.
if it's matching expectations, then we're going to be pretty flat. If all of a sudden there's a lot more unemployment or new job openings start significantly coming down, then you can expect interest rates to follow that.
Okay. So I have a question, which I've been confused about for a long time. I think I'm starting to see how this all works, but I'd like if we can share it to the audience. When it comes to the federal funds rate, like the Fed, they don't really control mortgage interest rates, right? But they have some influence.
Yeah, I mean, it's a factor. It's not the only factor, but it's a factor. The Fed's funds rate is basically the rate for overnight borrowing for institutions, which is kind of how the Fed controls the temperature of the economy.
Yeah. So is this the interest rate, like when they set it at, like, let's say 4%, the federal funds rate is 4%. Does that mean that the Federal Reserve is paying bonds at 4%, and so people can go get that kind of returns? Or does it mean that, like, hey, you can borrow from the Fed at 4% and go invest that debt? Like, what exactly does that mean? Like,
It's not really for us. It's for financial institutions who are borrowing money. It directly impacts things like auto loans, credit card rates, HELOCs.
Okay.
As you know, we've had a couple of Fed rate cuts this year, your HELOC probably adjusted its interest rate to match the Fed, within a week of them actually cutting the rate. So it's very directly tied to that, but mortgage interest rates are kind of a different investor product, which are more closely tied to the 10-year Treasury. So, I mean, that's what they like in September, October, November, as the Fed's cutting rates, interest rates have went up, which is counterintuitive. You're like, well, what the hell? I thought it's because they're not really tied together. They are influenced by each other, but mortgage rates are very much speculative in terms of what investors anticipate the next 6, 12, 18 months to look like.
Yeah. And I think what a lot of people just don't understand, and even people in the industry, I think sometimes don't understand, is that there's like a mortgage servicing value out there that if they anticipate rates coming down, maybe there might be higher fees and it might be a more expensive rate because they have to compensate for potentially getting refinanced, right?
Yeah. So not so much right now, but about 12 to 18 months ago, if you were an investor trying to get a conventional investment loan, odds are there was not a par rate, meaning there's not a loan out there that gives you an interest rate that you don't have to pay for. All the investors, the secondary market, were baking in discount points that you have to pay just to get a normal basic loan. You couldn't stretch your interest rate high enough. Do you get what I'm saying?
Yeah. What's a discount point for those that don't know?
So discount, the par rate is if you apply for a loan and I say, hey, you get a 7% interest rate, that's the par rate. If you want to pay discount points, pay money up front to lower your rate, we can give you a 6.5% rate for $5,000 or a 6% rate for $10,000.
Okay. So you just have to pay for the rate coming down. So essentially it's still going to cost you no matter what.
Yeah, because
7% is going to cost you 7% somehow.
the reason for that is because they're saying, hey, this is an investor loan. And
Yeah.
so they're anticipating that you're going to be refinancing 6, 9, 12, 18 months from now, whatever the number is, however the math works on the back end. So they're trying to make their money up front because while this is a 30-year loan, they're banking on the fact that this is not going for 30 years. So now the product is less valuable. They have to put more upfront premium in order to make their money.
Is that the main reason why investor loans are typically more expensive than a regular consumer mortgage, where it's for your primary occupancy? Is it because they anticipate you refinancing more than a owner occupied, or do they really see it as more risky?
It's a factor, but investor's going to be a different risk class at the end of the day. And so that's why, it's going to be a 0.5% or a percent higher than a conventional primary residence for the exact same borrower, is because it's a different asset class. The thought, I think that, the thought is you're going to keep your primary residence. If you go underwater, that's going to be the last thing to go, versus you might be more willing to foreclose on a 4-unit in Cincinnati, Ohio, which I have for sale slightly above market value. If you're looking for a fourplex in Cincinnati, Ohio, let me know. I won't cut you a deal, but it's well above 1%, so it might make sense for somebody.
Right on. And if you guys want to hear about that, you got in depth on how you purchased that fourplex. The thumbnail has a tank top photo of you, I believe.
Okay. Good.
So it's a year or two ago, I believe.
Yeah, it's been a little bit since we've had you on, but I want to just remind everyone, we kind of started the show and we didn't really give any context to who Brett Shoemaker is.
No.
For those of you who actually haven't listened to the first episode, you should go listen to it because A, Brett Shoemaker is very entertaining. B, he's actually very knowledgeable. So if you want to learn anything about mortgages, the self-proclaimed mortgage king is here to talk about that. But just real quick, Brett, if you don't mind, can you kind of give us some of your background so people have a little bit of, who you are and why they should listen to you in mortgage rates?
Whether you should listen to me is a little bit still up for debate. But I was a real estate agent as a side hustle for a couple of years, hated it. Not my personality type. About 2.5 years ago, I decided I do like real estate, but maybe would be more passionate about the financial side. So I tried my hand at mortgage lending. I'm a mortgage broker. I've been doing that for about 2.5 years. About 40% of my business is investors, and then the other 60% is your kind of everyday home buyer. This year, I'll do about $21 million in 2024 in terms of loan volume. So.
Nice.
I'm not the biggest guy in the area, but I'm gonna get there. So
nice. Mm-hmm. That's pretty impressive. And 40% investors. That's a lot higher than the average lender, right?
I think so. I mean, I haven't really.
There's probably not a way to track that, but I would just imagine.
I can tell you my own experience when I'm just brushing shoulders with people. The vast majority of people are not in the lending space are not well versed in non-QM loans. Yeah, which are the vast majority of investment type loans for at least 4 units or less.
And for the investors out there who want to be investors that just don't know about non-QM loans, I mean, that's your bread and butter, I would say. And they're pretty incredible loans. I remember for the first 8 years of me being a real estate investor, I was really trying to pay as much taxes as I could so that I can qualify for a regular mortgage. And it is a bitch trying to get normal mortgages when you're self-employed.
Yep.
As an investor, and it is just the most stressful thing in the world. And like what a normal loan would take you a month to put together, mine would always take, for some reason, 6 to 12 months for the average lender, and they have to go through all these rental properties and constantly get updates, and it's horrible experience. And then like when after COVID, when everybody was refinancing, they would put me in the back of the line, and every single month they would tell me, hey, everything's expired here now that an underwriter's got a chance to look at your file. So you got to resubmit everything. We'll look at it again next month when everything's expired.
I remember that process.
Yeah.
That was wild.
It was wild. It was just so horrible. But I did it so that I can get these low interest rate loans. And then I got a bank statement non-QM loan on a property that was a breeze, and it was like 0.5% more in rate, but it required a fraction, like 1/20th of the documentation and paperwork. And if we can talk about that, if I'm not mistaken, like a bank statement non-QM loan versus, like, they really just want to see like your income on your bank statements and your credit score. And that's the big factors that they're using, right? They don't look at your taxes, which is great if you're a self-employed investor and you want to take losses. But can you talk a little bit about the non-QM world and just like compare the bank statement loan versus the DSCR loan?
Yeah. So, mortgages at a whole, when you're underwriting somebody, you're underwriting their ability to repay the mortgage. And so there's different tiers of doing that. The best rates are going to be what are generally referred to as full doc loans. You give me all of your income documents, and you're a super successful W-2 employee who makes hundreds of thousands of dollars a year. Your pay stub comes every 2 weeks. Piece of cake. That's how 95% of everyday homeowners qualify for a mortgage. And then you get into the second tier, which is alternative documentation. One example that you gave is bank statements. And so what you're doing is a bank statement. You say, hey, Nick, you're self-employed. You've got a lot of different businesses. You're an investor. Rather than trying to make your tax returns make sense because you've probably taken a lot of depreciation, or you're probably taking a lot of business losses. Your companies don't make money. Let's just look at some of these bank statements. Why don't you give me the last 12? I'll take the deposits. I'll average them out. I'll remove anything that's an anomaly to your business. And then that's going to be your income.
Cool.
And so that's another way. You can do bank statements, you can do P&Ls, you can do CPA letters, you can do 1099 onlys. There's a lot of alternative documentation that you can do. The most common, generally, is the easiest, is bank statements, but there's a lot. And they're generally 0.5%, maybe 1% higher than the conventional loan, depending on the lender. But if you're talking about, whether or not I'm writing off $20,000 in federal income taxes, or I'm paying $6,000 in extra interest, it's a calculation that you consider.
Right.
And that's what I had to come to terms with. I'm like, dude, I'm going to save so much more money, even though I'm going to pay a higher interest rate, if I just take all the write-offs I'm entitled to.
Right.
And then, the tenants are going to pay the interest anyway. Why not try to just find deals that make sense?
Third tier, kind of above that, slightly more expensive, is an asset-based underwrite, where I don't really care what you do. I don't care who you are, what you do. I care about your credit. I want to make sure that you have the ability to pay the more that you're paying your bills on time. But we're largely focused on, what does the property do? All commercial if you're buying an apartment, it's calculated using a DSCR spread. Debt service coverage ratio. How much do the units produce versus what's the debt service? How much does it cost? And you can do that with residential loans too. 4 units or less. Get an appraisal on the property. It's going to rent out according to the appraiser for $3,000 a month. Maybe there's a lease in place. Maybe there's not. You can qualify for the loan based off of the anticipated rental value of what it is. You put 15, 20, 25% down, depending on the lender. And then, we look at the cash flow. And if it cash flows, and you have a reasonable credit score, that's all you need. We don't need any income documentation.
But it's got to be 4 units or less, so 4-plex or less.
Yeah,
for that type of loan.
Residential. I won't get too much into commercial. I do some commercial, but I'm not the guy to go into detail. Commercial is a little bit of a different beast, but it's in terms of underwriting, it's calculated the same way.
Yeah. So just to clarify things out there for the listeners, if somebody's out there just looking at a 5-plex or 6-plex, they can't get a residential loan on something like that. That you have to look at a commercial loan, which typically those terms are way different, right? In general, than a standard 30-year type of loan. It's like it might be amortized over 20, 25 years and then a balloon in 5 or 10. So just be careful if you are looking, as you're shopping for small multifamily, you're going to get better financing if it's 4 units or less. If you're between 5 and 8 units, I mean, you really got to make sure there's plenty of cash flow that can handle the type of loan you're looking at.
It's just underwritten differently. It may be a better deal if you're talking about a 5-unit versus a 4-unit loan. But how much cash you have to bring to the deal is completely different. Typically, a 4 units or less, it's, hey, come up with 20%, and I don't care what the ratio is, you're good to go. Commercial's not really that way. It's more driven by, hey, whatever we need to hit our certain DSCR ratio, and so you can have a loan up to that DSCR ratio, and then anything after that, you have to bring in cash. So that could be 15%, that could be 45%.
Sure, it just depends on the deal for sure and exactly how that's structured. I'm going to kind of sidewind this a little bit. Sorry, Nick. But, I hear a lot of people, a lot of investors specifically kind of complaining about interest rates, right? Everyone's saying like, oh, I want to buy when the interest rates go back down. I want to buy when the prices go back down. Like, is that something you see, or is that something that you foresee seeing?
In terms of the rates coming down, they'll come down. I think that the broad consensus is the long-term stability for interest rates is between 4 and 5% in terms of conventional lending. Whether or not it's Trump's in and it's going to be 60 days, I highly doubt that. Or it'll be more than likely it'll be gradually coming down over the next 2 to 3 years. I think at the end of the day, from the investor standpoint, the deal has to make sense today. This is not the time to. This is not 2020. We're not buying things on a hope and a prayer, and an appreciation is going to save us. This is not that market. So it's got to make sense today, and then it'll get sweeter over time.
Yeah. So, investing's gotten harder, hasn't it?
Yeah. I mean,
which is kind of exciting. I think it's going to drive away a lot of the, people that aren't really that serious, or people that really shouldn't be investing, that might have to give up some good assets. In general, this is just my thought pattern. It's like, I don't see any time in the near, 5-10 years where investing is going to be as easy as it was in 2019 or 2020, where you can get, a property that's half the price that it is now at half the interest rate. But maybe I'm wrong. I just wouldn't, if you're out there and you're just waiting for that to happen, very, very unlikely. But what do you think? Could I be wrong?
In terms of like the easy deals?
Well, I think there's a lot of people out there, surprisingly, that I see on Facebook that think the market's still going to crash. Prices will come down by half, and so will interest rates.
The market's not going to crash.
What has to happen for that to happen? Because I don't ever foresee it going back down, but I also don't foresee the mass appreciation like you were talking about ever happening again. Like, I think we're almost at like a breaking point for like what house prices could and should be that are affordable.
So, I mean, outside of it's an 8 type of anomaly disaster where there's poor lending practices combined with institutional corrupt, like there's a lot of things that went outside of something like that, which there's a lot of rules that have been put into place that prevent that, or some sort of crazy COVID. Obviously, COVID was good for the real estate market, but some sort of unpredictable, crazy disaster, the market is not going to crash. The second interest rates come down, appreciation is going to go back up because it's all about affordability. And when you look at 2008, affordability went through the roof because everybody was on an arm. And it only takes, 3% of America's arms if everybody's on one to default, and then we're in a massive financial crisis. So it's not like 50% of people were losing their homes. It's a small fraction, but, these are all investment products. And so the next thing you know, these banks are going down because they weren't expecting $1 billion in defaults over the course of 3 months. So I'm not an expert on that. but the market's not coming down. The second interest rates go up, it's going to appreciate. It's not going to go up 42% year over year like some parts of the country did.
Right.
But the idea that, hey, I'm going to wait, for the market to come down 20% before I buy.
Mm-hmm.
Dude, you've probably been waiting since 2017, and you're gonna be waiting.
Yeah,
you're gonna be waiting some more.
That's just an excuse to not make a move, I think, in my opinion, honestly. So
The reality is, if you bought in 2006, like you were okay in 2012, 2013. There's been like 3 years in the last 100 where real estate is worse in terms of value 5 years from now than it is today.
Yeah.
And so you could be really unlucky, but looking at 100 years of data, if you can hold it for 5 years, you're going to be fine.
I remember doing a video in 2016 comparing the market in 2006 as of today. And if you bought a house in 2006 and just sat on it, you were able to keep it at some point, and you eventually refinanced it at some point, you would look like a genius, and you would have purchased in the worst time in U.S. history to buy real estate, because just the next couple of years your value could have gone down by 40-60% in some markets. I remember working in Florida in 2010, late 2010, early 2011, and some of the houses that I was selling were going for 60 to 80 grand, and just a couple years before that they were in the upper 200s. So it was less than half in some parts of the country. But still, if you bought in 2006, the peak of the market, and you were able to just hold on for a decade, you still look like a genius, because you would have brought in rental income that whole time, potentially. You could have refinanced at the right time when everybody hit the refinance button, and you would have still had appreciation over that time, even though there was this massive dip.
right.
And that was 8 years ago I made that video. And if you held on, you'd look even better today.
Well, think about what happened 60 days into COVID when people were being laid off and not going to be able to pay their mortgage. The government just kind of made up a rule. You know what? Foreclosure moratorium. How's 6 months sound? Like, we can do that?
Yep. We're the government. We can do whatever we want.
Okay.
Yeah.
And so
And no evictions either.
I think a lot of modern day investment either came to adulthood, like myself around 2008, like you guys, or they remember it so firmly that you're just constantly in fear that that's going to happen again. And over the course of a year, prices are going to go down 40%. But America's not going to make that same mistake twice. We might make some other mistakes, and we will make some other mistakes.
We're not perfect by any means, no matter who's in charge. It's like there's no perfect anything.
Yeah.
Yeah. All right.
There's a Hunter Biden joke in there somewhere, but
Oh, yeah, we can make jokes about politics all we want, but I mean, like what I've said on this podcast before too, like it doesn't really matter who's in charge. Like my world is such a minimalist world. If I like control my sphere outwards, life's going to be just fine for me. And that's why I try to tell other people too, like, dude, whoever's in charge, whether it be the candidate you voted for or the candidate you didn't vote for, like, you still have a lot more control than you think. Don't just yield and say, well, it's just up to them now. Like, you can still do so much to fix this. Speaking of that, though, I just kind of want to dive into real quick. So, a lot of people have this mindset of, just if that crash happens again, how can people avoid that? From their own personal sphere, and what kind of steps can they take to better themselves in the event of a crash, or in the event of just a downturn in the market? Like, how can they protect themselves?
I think a lot of it comes in the decision to buy. If you're an investor, you should be buying opportunities for a specific reason with specific upside. If you buy something at a 30% discount, which is hard to do, or a 30% crash, which is the worst ever for the record, you're still fine. If there's a lot of different reasons. I think in terms of risk mitigation, obviously you want to have your reserves set aside. You don't want to tap out your appreciation to the tippity top. But it's just conservative decision making right now, that we're not making decisions based on anticipated market results, because we don't know what's going to happen. We could have 4% in the next 9 months, but I'm not going to make an investment decision based on that. We could have 6% year over year appreciation locally or in specific parts of the country, but I'm not going to make an investment decision on that. I'm going to make a decision based on the numbers today, and then as the deal gets sweeter over time, I look like I'm smarter.
Yeah, that's true.
Yeah.
We all want to look smart here.
Yeah. Yeah.
Yeah, once you lock in a deal, it seems like it could only pretty much get better from there, as long as you're managing your property okay.
Yeah. No, I mean, there will always be opportunities to refinance, whether it's to extract appreciation or lower your rate. That's always going to be there as long as you bought it at a reasonable price.
Yeah. There's also, too, like mortgage insurance, over time that could go away and your payment can go down even further just by, either refinancing or getting an appraisal on your property if you're out there and you have mortgage insurance. But anyway, they're not just refinancing when rates come down. There are other ways.
There's a lot of factors that come into why you should.
And if you raise your rents every year, just by a little bit, it adds up over time.
We have a mutual client who, is basically buys a house every year and this is not tax advice because I'm an idiot. I ball tanned before I got here. Which means I exposed my testicles to direct sunlight.
Just before you got here?
I preface
there's no sunlight in
December.
Now you know why I was late.
Oh, okay.
So I preface that to say clearly I know nothing about taxes. But we have a mutual client who buys a property every year to Airbnb it to do a cost seg so that they make great W-2 income. Mm-hmm. But when you're a W-2 employee, you can't write off your taxes. So they are applying the depreciation from their property via cost seg to their W-2 income because owning and managing an Airbnb is considered active income. Doesn't really matter in this person's scenario. The price doesn't really matter. The performance doesn't really matter. The fact that I can depreciate a significant amount of money to my exorbitantly high W-2 income, the tax savings outweighs the performance of the investment.
Yeah.
Obviously, you don't approach it that way, but I think the point is everybody's situation is different. Talk to, real estate agents who are investor minded, not somebody who has a license that, I can help you with an investment property.
Right.
They don't know what they're doing. Or it's the same with mortgage lenders. It's the same with a lot of industries that are tied into this space. There are people who specialize in different things.
Can you give us an example of maybe a deal you did recently where you did help somebody get a non-QM loan, either a bank statement or a DSCR, and just kind of like what it looked like?
Yeah, I've got a couple right now. One went under contract yesterday. Basically, a gentleman and his partner are buying a duplex here in town, Coeur d'Alene.
Okay.
But in order to come up with the 3.5%, they need to extract equity from another property. Self-employed, one of them's self-employed, one of them is employed. So the one with the W-2 income is buying the property based on their income. Mm-hmm. But the down payment assets are coming from the guy who's self-employed. He's doing a cash out refinance on a DSCR to get the cash that they need to, one, pay off some debt, consolidate debt, but also come up with the down payment to buy another property. And so with that, credit looks good. Give me the lease, give me your current mortgage statement, give me your property tax bill, and your insurance.
Yeah.
There will be a little bit that comes out of underwriting in terms of follow-up to make sure everything's kosher, but in terms of, do you qualify? That's what we use to determine if you qualify for a DSCR loan.
Hey, quick commercial break here. Thank you so much for listening to this podcast. I really do appreciate it. If you want to give back, let me help you buy a house, or I can help you sell a house. It's the only way I make money when I'm not investing in real estate. I don't make money on this podcast or the events I do, but I do make money only when I help people buy and sell houses. So if you're looking for your next investment and you're here in North Idaho, I want to help you personally. If you are not in North Idaho, I can still help you out. I have a vast network of referral partners all across the country, and I can find the right real estate investor savvy agent for you so you don't have to. It doesn't cost you a thing. Thank you for your support. Back to the show. Yeah, right on. Yeah, and you recently pre-approved me, I think, or pre-qualified me, but that was also not a investment property. It was just going to be a primary residence, but you can still do these types of loans with that as well, right?
Yeah, so the DSCR loans a little bit trickier. Those are generally investor specific, but when we get into that alternative documentation,
bank
statements, all of that, you can buy primary residence. You can also, there are no doc, no income loans. So if you're loaded and you have 30% to put down, I don't care what you do.
Wait,
30% sufficient enough for me.
No doc loans are back?
They're back, baby.
Tell me more. Okay, I gotta hear. Wait.
Yeah.
What's the hitch?
They're higher interest rate. So
Okay.
I'm
By how much?
I'm closing on one on Monday. It is going to be about 7.75%.
Okay.
30%
So not
down.
crazy too much. Is this an investment?
It's a primary.
Oh, okay.
So that you would only do this for a primary because the DSCR is essentially the alternative.
So this is like a point higher. Because
Yeah.
like rates are around 6.75 or so right now.
Right. Now I should say I believe there's some discount points involved in this.
Okay.
So if we're looking for a par rate, it might be closer to 8.25, 8.5, something like that. But basically 30% down. It's your primary residence. You have to have 12, 18, maybe 24 months in reserves. It varies by the lender. There's only a couple lenders who do this, and that's it. I mean, obviously you have to have good credit.
But wait,
history.
you said no docs. They still want to see you have money in your bank.
Well, yeah, we gotta prove one that you're not funded by the Taliban or maybe the Chinese. I always say the Taliban, but now it's more like the Chinese.
Okay, good.
Go Taiwan. But then we also have to.
Do you care where the reserves come from? No, I just, you said like, you don't want it funded by like China or the Taliban or whatever. Like I know like from like the mortgages I've gotten, like they just need to see that it's been in my account for a month in order for it to qualify as my money, right?
Yeah.
So how do you mitigate that? Because I mean, that's not even your problem, I guess.
So there's kind of two questions here. It's like, one, what assets count as reserves? Yeah. Like, does crypto count? Yes, crypto counts as long as it's in like a verifiable institution and it's not in Djibouti, Africa, in somebody's crypto wallet.
Okay.
But so what types of assets? But then the second question is, how long have you had it? And so you can have asset seasoning from anywhere from 1 day to 60 days. Okay. Basically, you can be funded by China, but it needs to be 60 days ago.
Well, yeah, you need to hold the money for 60 days.
And I'm sure there's some compelling reasons for that, but
Right.
yeah.
I was just curious how that worked because you said you want to make sure the money's funded from a certain source, but after a while, like you guys stopped checking, so it's like
Yeah, that was obviously a joke. You can't. We shouldn't be taking money from foreign adversaries to buy American real estate.
why not?
There's another Hunter Biden joke somewhere in here.
Hey, do you ever do combo loans?
What's that? Like a blanket?
Like an 80-20? Like you do two loans. One loan for 80%, another loan for 20%. Like, do you ever do anything like that?
So in the mortgage world, there's something called closing LTV. So in order to close on the first loan, what's the closing LTV of all of the loans that are attached to the property? Generally, unless it's some type of down payment assistance, you're not going to be able to get a closing LTV of 100%, meaning you have to bring zero. Yeah. It is common for like an investor loan buying a investment property or maybe a second home to do multiple loans at the same time, where you have one loan for 80% or 75%, and then you have another loan for 10 or 15% to get you to 90% value. That's much more common. The reason you do that is because in the mortgage world, there's something called a loan level price adjustments, which when the LTV is below, loan to value is below 80% or 75%, the loan gets significantly cheaper than if it's above that. And so the math on the back end is, am I better off with a 90% one loan that's 7%, or am I better off with an 80% first loan at 6.25% and a 10% second loan at 9%? Right. And so there you would calculate the blended rate. There's obviously other factors. If somebody's expecting a large sum of money in 6 months and they're going to pay off the second loan, then let's get the first loan in place. There's a lot of reasons why you might do that, but is that what you're talking about?
Yeah, I just remember this was, I think my brother got a loan from Numerica on his first house back in 5 or so. And it was, one loan was for 80, the other was for 20. He didn't have to have mortgage insurance, but he still didn't bring anything to closing. But this was, back when loans were just a potato kind of thing.
You could give a hand job and get a loan.
Yeah. Well, you don't even have to go that far.
I wouldn't know about that.
You wouldn't know about that. So those don't really exist as much.
I would be surprised if there's, it might be out there. I talk generally in terms of the traditional loan market, conventional FHA, USDA, VA. and then the non-QM market. But then you get into like Numerica, which is a credit union.
Yeah.
They can make a portfolio of whatever they want.
Yeah, maybe that's what it was.
They can lend money however they want. I would be surprised if something like that still existed that's not attached to an FHA loan. That's really risky banking investment,
Right.
But if it is attached to an FHA loan, FHA is not going to let you go above 105% or something, and it has to be. There's a lot of rules and regulations. So the answer is maybe,
Okay.
but I doubt it.
What would you say outside of complexity? What would you say is probably the most underrated loan, whether you prefer to do them or not? But what do you think is like one of the most underrated loans that like hardly anybody talks about or thinks about that are actually really great for investors or home buyers or whoever?
Like a first-time home buyer or like a...
Whoever. Just if you can think of like what comes to mind that most people don't even think about that is a great product, but just maybe because of complexity, most people just don't even talk about it.
I mean, my favorite loan by far is the VA loan. I think they have the reputation for being harder, but if you're a veteran and you can put 0% down, you can get the seller to pay for all of your concessions. Again, lender specific, but we just made an offer yesterday, it was 800,000, 50 grand in concessions. Mm-hmm. Now, hold on. I thought the maximum concession on a VA loan is 4%.
There's additions you can do, which you're going to talk about. But I remember learning about this in broker school. VA loans, you can get a lot of different concessions. You can pay off credit card debt and all kinds of stuff. But go ahead.
So we're paying off like 32 grand in debt to help this person qualify.
That the seller's paying for.
The seller's paying via a seller concession, which there's like nothing else like that in the marketplace. Obviously, I don't know if that offer is going to get accepted. 50 grand's a big, but it might.
It might, yeah.
So
you don't know if you don't try. That's
the
for
VA
sure.
doesn't have a cap right now, right?
A cap on,
like there used to be limited to like $417,000 entitlement.
Right. There is and there isn't. It's all driven by VA loan eligibility, and then it's also in conjunction with what your income is, and there's something called
assuming that you have unlimited income.
Yeah. That's going to be the limiting factor, is whether or not your residual income allows you to qualify for the home that you're trying to buy, but there's not really
a max purchase price
that
you're going to run into, because that used to be a thing, but I think I've never really heard of it until recently. Nobody was getting VA loans for over 700 grand or even over 400 grand at one point, but they must have just took the lid off when prices went crazy.
Well, I think residual income, it's much more sophisticated of a calculation than debt to income, which is how traditional loans are calculated. And so that helps keep people within their means at the end of the day.
So what do you mean by that? Is that like disability type of income or like regular income that they're going to get no matter what?
So residual income basically takes all of their traditional income, but then it applies additional factors outside of their debts listed on their credit report. For example, what's the square footage of the house that you're buying? If you're buying for simple math, if you're buying 1,000 square foot house, we're going to assume that $140 a month is the cost for utilities. And so that's factored into the residual income. Do you have kids? Are you married? Geographically, where do you live? All of these are like little details that determine what your residual income is that you don't have to deal with FHA, conventional, USDA, non-QM.
Right.
That's exclusive to VA, but it gives a lot more of a true cost on your ability to afford the house based on more factors than pay stub and credit report.
Yeah, I was way off. I thought residual income was something that you make on a recurring basis, but doing one type of deal or transaction, or like rental income could be looked at as residual income. You do a deal once and it pays you every month. Maybe there's different definitions.
Well, yeah, I mean, in terms of the VA. Now, you can use income in the VA residual income calculation that's not allowable in the traditional DTI calculation, meaning if you have some sort of side hustle that you consistently do, that we're not going to muddy the waters with the actual underwriting of the loan, but you can get qualification for residual income credit. But I don't think that's what you're talking about.
Yeah, no.
If you're not a veteran, if you are a peasant and did not serve our country.
Are you a peasant, Brett?
I did not serve.
All right, welcome to the club. We love our service, but yeah, we dodged that draft so hard.
I like to pretend I was in the military.
No comment.
I like to pretend that Nick's wrong. Actually,
I went to MAPS. Okay, that's where you swear in and then you back out later.
Yeah, I thought about it, and then I think I was there taking the ASVAB, and I tried to like turn in some paperwork, and then the dude told me to back up behind the line, and I was like,
I don't like your
this
tone.
isn't for
I don't
me.
like your tone, buddy.
I'm having an oppositional defiance flare up right now.
Yeah. Remember during MAPS, like after you do the ASVAB and stuff, and then they have to do the physical exam on you and all that stuff. And then they want you to pee in a cup, but then they have to like watch you and they have to see your penis and they have to watch your penis fluids go into the cup at a very close distance. That was uncomfortable for me at the
We
time.
talk about penis fluids and testicles on this podcast.
I got a question. Let's talk about circumcision while we're on the topic.
Yeah.
Wolverine's power is he can regenerate himself.
Mm-hmm.
Is he circumcised?
Yes. So he can regenerate himself, but that happened prior to his adamantium skeleton being. I don't know. You would think like it's like a previous, insurance doesn't qualify you for previous existing conditions. You would think circumcisions go the same way with Wolverine.
I just hope no matter what, it has the same sideburns.
Yeah.
Yeah.
This conversation is back to your original question. If you're not a veteran, dude, the best, easiest way to purchase a house in terms of like, hey, I don't make $1 million a year. How am I going to save up 200 grand to buy whatever? Is primary residence churning. Come up with 3.5%, 3 or 3.5% for your first one. Every house you buy after that, move into it. 5% down, conventional loan, you can do it a bunch of times. The burden of entry is much cheaper, right? 20% versus 5%. You have to move. So if you're, my wife told me I can't do that. This is the last one.
Mm-hmm.
So, but we've done it 4 times.
And if you're in Idaho, you can still potentially get the Idaho Housing 3% to help you out too, right?
Yeah. I mean, there's a number of.
So if you get a
ways to do
5%
it.
down, maybe it could turn into 2% down.
Yeah.
Yeah.
Do what I did and marry a realtor and use your commission from your selling the house to yourself as your down payment.
That's another strategy. I mean, there's so many things out there if you actually want to do it. But in terms of, buying a primary residence, it's one of the only ways in your life in the economy where you can leverage 20x in your money. Mm-hmm. Meaning if I put 5% down, they're going to give me another 95% on a loan on what's quote unquote an investment. There's not any other investment product out there. And then keep in mind that the appreciation is not based on your 5%. The appreciation is based on the property that you bought. So if it's very simple math, if I put $5,000 down to buy a $100,000 house and it goes up 3% next year, which is very reasonable, that's a 3% gain in appreciation on my $5,000 investment. That's a 60% return on actual money that I was
going to say that's an 80% return, but I don't have a calculator in front of me.
That math don't math.
And then it keeps going, it compounds. Obviously, you have to pay your mortgage and there's cost of home ownership, but in terms of simplicity, that's a great way to get started.
Yeah, we call that the Joe Turner method around here. What she does, she just buys a house, lives in it, fixes up a tiny bit, moves out the next year, and then just rents and repeat. Yep. And that's a really great way, but also that only works for certain people, of course, because you can either have a lot of leverage in a house, or you can, with the prices in the area now, like 3% down on a normal house that you're going to move into doesn't really pencil out. So, if you are able to put more down and like lessen how much your mortgage is, that might be an option too. Just, there's a lot of different sliders on this stuff. So talking to a mortgage professional like yourself would probably be the best way to figure out exactly how to make that happen.
But if you really want to live in North Idaho and you still want those numbers to work and you don't have the time to hit the streets and try to find a 30% off deal, you could potentially still buy a triplex or a fourplex and make these numbers work, right? Mm-hmm. With today's interest rates. Mm-hmm.
And it helps your qualification.
And you can still put a low amount down.
Yeah. 3.5% down on an FHA loan or 5% on a conventional. You can buy, you can buy a duplex, triplex, fourplex, and then the anticipated income of the other units can help you qualify for the loan. So if you've gotten pre-approved for, you make $72,000 a year and you got pre-approved for $350,000 and you're like, it's hard to find what I want for 350,000, but there's a duplex for 525 that looks reasonable.
Right.
You might qualify depending on what the other unit rents for.
Totally.
So,
Get the tenants to help you qualify.
yep.
Yeah.
Do you have to figure that number out before you get qualified, or how does that actually work?
So this might be like if we have somebody who went under contract on a duplex yesterday, prior to the pre-approval, I went and looked at the property on virtual. I'm not driving around. I don't even go to closing.
I know. I'm surprised you showed up here.
Yeah.
It was late as hell, but you're here.
I look at the property online. I say, this very conservatively will rent for $1,500 a month. Sure. It's more likely going to rent for $2,000, but I don't like surprises. I'm going to be conservative. $1,500 a month. You get credit for 75% of that, which is $1,125. So now we've added $1,125 to your qualifying income per month, and that's how it works. And
So you don't actually have to have a lease in place in order for that to actually get approved. That's good. For some reason, I always thought it was the opposite. Like, how would I make this work if I don't have a tenant in? Do I have to like fudge a lease, or?
So it's like what the appraiser puts in their report of what, like a rent schedule of what they anticipate the rent should be. Don't you? If you still kind of have to have leases in place for that income to work, right? In some cases, or not always.
What do you mean?
Like, isn't a lender still going to want to see leases on other units helping pay the
there's difference
going towards the income?
There's difference between Fannie and Freddie, but you can buy a house or you can buy a duplex 5% down, no lease in place, unit is vacant. We'll just use 75% of whatever the rent schedule
Gotcha.
is.
Cool.
And then it's your responsibility to get a tenant in there and actually be able to afford it, but we can qualify you based on that.
Nice. That's awesome.
Yeah.
Why aren't more people taking advantage of this stuff? Is it a lack of supply or is it a lack of knowledge?
Yes.
Both.
Yeah.
Okay.
Yes.
That's a both thing. All right. How do we?
So I got another question. I know we kind of talked about this at the top of the show. You have a fourplex in Cincinnati, and you were selling it for slightly above market price. First of all, props to you for getting what you think it's worth. Why are you selling it?
So I bought it about 2.5 years ago. It's a great investment. Cash flows. To really quick go through the specifics, I make about $3,350 in rent. The mortgage on it is $1,400. Okay. So cash flow is great. Granted, I'm on a 4.5% mortgage. So if you're buying it today, you're probably, depending on your down payment, adding $400 to $600 to your mortgage. But still, you're going to be clearing after property management very easily $1,000 a month. And I'm selling it for $289. So you're probably gonna have to bring 50 grand, 60 grand. Let me math. Yeah, 60 grand at the table, but you're gonna make $12,000 a year. Like, that's a pretty decent return.
Yeah, your cash on cash is 25% there.
It makes sense. The reason I'm selling it, I've got about 140 grand in equity minus selling costs. So agents. I know people like you. I know a lot of other people locally that I feel like I can better capitalize on that money just for the deal flow that comes.
Yeah.
To my email inbox from people like you or whatever who need money or want a partner. And so I just think that it's like an opportunity cost. I'm not selling it because I'm underwater. It's a bad investment. I think I can make more money elsewhere.
Sure.
And it's a little bit of a headache, a little bit of like in the back of your mind. I don't do much, but I don't want to think about it.
All right. Was that the house? I can't remember. Was there like a boiler room problem in that one? I remember talking about that with you.
We had some issues.
Yeah, there's some issues. It's a rental property. There's going to be issues with houses.
It's also a C-class neighborhood, so the rent's not always there by the 5th. Sure. I'm 5-0 on evictions.
Nice.
In 2.5 years. So
Kobe.
Let's go.
5-0. What do you mean by that?
5-0 in a quadplex. How did that go?
Four of them were.
You mean like you lost all five? Like
No,
like 5 people.
No, I successfully evicted. It's just like a positive way to spend it.
Yeah.
Kobe.
You're undefeated in the eviction game with that property.
Yeah.
That's a lot of evictions. Is this a bad area?
The tenants immediately stopped paying rent when we moved in.
Oh, okay.
So 4 of them were right there.
Yeah.
And then one other tenant just didn't work out.
We had a property manager on recently who runs an AI property management company, and she has all these names for her people like Compliance Charlie or whatever. And I was trying to pitch Break Your Legs Benny. So it's an AI bot that comes to your house and really threatens the tenants.
I thought it was Break Your Legs Brian.
It might have been Break Your Legs Brian, but I like Benny better.
Okay,
that
Benny's
sounds
fine.
more like a mobster who'd break some kneecaps.
Benny.
Yeah.
Sounds racist.
So you're selling it to just do other projects, right? You're trying to do private lending. It kind of sounds like.
Maybe. I'm hoping that Nick just calls me and he's like, "Hey, I've got a great deal.
There you go.
Want a partner?"
That's what he loves to do.
I'll do all the work.
Yeah.
Dude.
We do that all the time. I love it. Yeah. If you need extra money, I'll go in on
There
that
you
with
go.
you.
Yeah,
He just
same.
paid me back on a deal where he's like, I need money, and I use my IRA for it. So
I'm working on deals. We can talk later.
Okay.
About that.
But that's essentially like I'm trying to be the mortgage king. Like
Yep.
that's my focus.
Yep.
But I'm real estate. I have a lot of knowledge in my head. I know what's a good deal, what's not a good deal. I'm real estate minded, and like I said, because of networking with people like you, there's just a lot of opportunities that come up that I want to take advantage of.
Yeah, that makes sense. You want to just be a little bit more active with your investments.
Yeah.
Yeah. I could appreciate that.
Yeah. And real quick, I know we're kind of getting to the point where we're winding down, but you mentioned at the top of the show that you are a mortgage broker. What's the difference between a mortgage broker and someone who just originates mortgages?
So, I mean, we all have, well, I shouldn't say that. Technically, we're all loan originators.
Mm-hmm.
Some of them are licensed. If you work for a bank, you're not required to be licensed. You kind of
Right.
come under the bank's license. I'm a broker, so I work for you. I don't work for the snobby lender.
Yeah.
I work for you to find the best deal.
That's what I do with hard money. Yeah.
Yeah, it's exactly the same.
So that's like a real estate agent. I'm a broker. I work for a buyer, and I'm showing them around all kinds of different properties with other brokerages, and I can go hunt and help them find the best deal.
Yeah.
So that's kind of like you with mortgages. You can go out and shop and find the best mortgage for somebody, right?
Exactly. So, and I'm a broker because I think it's the best, but there are benefits to being a retail lender, meaning you're working for a bank or a
Right.
credit union or something like that. There are also benefits for working for a mortgage company, like a Rocket Mortgage or a Waterstone Mortgage or something like that. So there's benefits to everything. I like mortgage brokering. I think, practically speaking, you apply for a loan, click a couple buttons on my software. It's all automated. I've got like 180 lenders that I shop your deal to.
Nice.
Now, we don't always go to the cheapest one. It's like a lot of things. There's price,
Yep.
there's speed, and then there's service.
Yep.
If you've got 90 days and you want to give me every document you've ever had in your life, I can get you the best interest rate available on the market.
Yeah.
That's not always the case. Now, if you call me and you say, "Hey, I have a client," and this happens a couple times. I have a client who fell out of escrow. We have to close this as soon as possible, or the seller is going to go with another offer. Boom, 10 days, we can get it done.
Yeah.
Speed,
Sucks, but you can do it.
it's going to cost some money.
Yep.
You're not going to be getting the best interest rate that's available. So, being a broker kind of gives me that flexibility to respond to the needs of the client. Plus, there's a lot more money in it.
Yeah.
If you can go out, there's me and my loan processor. That's it. Nobody tells me what to do.
Yeah, I saw how much you made today, and I was like, he made more than I did, and he never went to this house.
Whoa! What are you trying to say?
No, I'm just like, I'm like, man, maybe I should be a mortgage broker. Just because
You should not be a mortgage broker.
No, I'm not envy. I'm proud of you, and I'm proud of how much you made, and it just makes me feel like, wait, am I all of a sudden on a different totem pole here? Because I'm only getting paid like $3,000 after splits and all that stuff. Didn't you get? I think you got 7 or something on that one. I don't know how much you split with your company.
So,
But I was just like, I don't think he didn't have to go shop for a house. He did shop for a loan, but you never had to open a door for a buyer or like constantly go back for inspections, do walkthroughs, those kind of things.
Well,
but there's a lot more to it than I didn't have to collect documentation. I didn't have to constantly be on top of that stuff.
this was the easiest client ever.
Okay.
As you know.
Yeah.
He wanted to buy everything, but yeah, I do have a split. So I had to pay like $1,000 off the top plus 10%.
Okay.
Is like my split. So
Yeah.
I will take your word that it was 7,000. I'm not sure. And then I have a processor who I'd pay kind of a flat rate per file.
That looked like a separate charge too, though. Like the deal paid the processor separately, or
No.
or it was an underwriting
There's
fee.
an underwriting fee that kind of goes to the lender, so that's
Okay.
not technically for me. But at the end of the day,
The buyer looked like
I'm
it didn't even pay for it though.
I'm
It like
paid
came
by the lender for bringing them the loan.
right.
Gotcha.
Yeah, like it wasn't something that was pretty cool what I saw in there, because usually the buyer, the borrower, they're the ones paying for those kind of fees. But with you, it's like Derek didn't have to pay it necessarily. Maybe it's baked into the loan like everything, but you don't have to. He didn't have to come up with an extra $7,000 of cash to
Right.
close on that.
There's a little bit of salesmanship that goes into it, because at the end of the day, it's all baked into the loan.
Yeah.
But yeah, my fees baked into the loan. The cost of the loan itself is baked into the loan. So the borrower doesn't have to pay anything. Now, granted, the interest rate that they're getting is assuming that those costs are baked into the loan.
Right.
But I'm a broker. I shopped 180 lenders. The interest rate's already good.
Yeah,
Right.
that's true.
So
Yeah,
I'm
it wasn't a
worried
bad
about
interest
it.
rate.
Yeah.
So just curious, if he went and he refinanced his loan in the next 6 months, do you have to refund your brokerage?
So yes. So if it refinances, and it varies by the lender that I broker the loan to, but if he goes out and refinances in 60 days, we do have to. It's called an early payoff penalty.
Okay,
Yeah, we have to pay it back.
60 days.
It's happened
Ish.
once.
Okay.
I'm sure
yeah,
it was a lot because you did all the work.
Nothing's
Yeah.
worse than getting a paycheck and then being like, "Oh, I don't get this paycheck anymore."
Yeah.
Here
Well,
you go.
that's
I
got to
did the
bull
work.
the most, because I can understand if a deal just didn't go through, and then you did all that work, but nobody benefited, so nobody's getting paid. But you did all that work, the loan went through, they enjoyed their loan, and they had every right to pay it off early. But then you have to pay it all back.
Like,
Is it pretty well disclosed up front?
no, the
No?
end consumer has no idea. If I have,
Oh no, I mean to you.
yeah, I know.
Okay.
But it's there's some negotiation. Sometimes, like if I do a lot of volume with one lender, they'll be like, you know what, don't worry about it. We'll take it out of ours, which like we can appreciate.
Right. If you keep sending them deals, it just ends up paying for itself at that point. So
I would say that's probably not the norm. I don't know if this is exclusive to the broker world or if like retail lenders or mortgage company loan officers have to deal with the same thing. I would assume so. Like at the end of the day, this is an investment product that's, if it doesn't go for a certain amount of time, nobody makes any money. So why should the guy who originated it? If I have some sort of inclination that this is a short-term loan, I'm just super upfront. Hey, just so you know, if this gets paid off within 6 months, I have to pay a penalty. It's usually what I say. I have to pay a penalty.
yeah.
Why can you just put in a prepayment penalty?
Not on a primary residence.
Not on a primary. Okay.
There are things I can do to try and protect myself, but it's like I can do something called borrower paid, where borrower is paying me directly and there's no credit being given for the interest rate to pay me. It's kind of
Got
like
it.
a little bit of working around the rules, but it's kind of frowned upon because you're going around, and I don't like. I'm here for the long haul.
That makes sense.
Right.
I'm not trying to do anything.
So is it usually within 6 months? If it goes past 6 months, you're clean then? Yeah, cool. Just try to tell people like, hey, make sure you keep this seasoning for 6 months or you'll get in trouble.
I usually don't bring it up. A lot of my language is like, you can refinance as soon as 6 months. I try not to. Most people aren't. If it happens, I have ways of getting notified so I can reach back out. But honestly, of the, I don't know, 150 clients that I've had in the 2 years that I've been in the business, I would say that all but maybe 5 are probably going to come back to me.
Yeah.
Because I did a good job and developed some, like, just like anybody else, some things I've butchered and have not done a great job.
Joe.
We're human. We make mistakes.
Yeah.
I'm just kidding.
Yeah. So like that happens, but I like to think that I'd be a part of the refinance conversation, whether that's in 90 days or a year from.
Yeah. Take care of your clients to take care of you for sure. Yeah. So kind of going forward, Brett, like what's your plans going forward? Obviously, like you said, you want to do some maybe partnerships, private lending. What else are you planning and what else are you working on?
Yeah, I want to grow my portfolio for sure, more locally. I think longer term, maybe 5 years down the road, I do want to get into the larger scale apartment type game. I think the opportunity to add value is a lot more significant there, at scale, I should say. In terms of like the mortgage world, I do want to start my own brokerage. I haven't been shy about this. I just want to start my own thing. We're build a little team of people who do a really good job.
Yeah, that's awesome.
And
when do you think you might start that? If you had to guess,
it's on the goal list for 2025. It'll be late 2025, and I'm not trying to like take over the world. I would like to just have like killers. Just a small team of whether they live here. Well, I could probably take like a couple of local people, but at a certain point, like I don't want to oversaturate the local market, but just people who are hustling that want to do a good job, and either they're doing a good job now or they need a little bit of coaching to get there. And that's like the long-term goal.
Nice. That's awesome.
Yeah.
Right on.
So where can you do loans right now?
So I can solicit business in Idaho, Washington, California, and Texas.
Okay.
Now, if you are someone who is not in New York, but you want to have a loan and you'd like me to be part of that transaction, I'm not allowed to solicit any business from you. However, my current brokerage, Edge Home Finance, has licensed originators in every state except New York.
There you go.
So I can help you through the process. Just give me a call.
Cool. Yeah, I just wanted to kind of give you a quick plug there, obviously, and see exactly who could be contacting you for business. Obviously, if you listen to this, like I said, go back and listen to, I think it was season 3 Brett was on? Was it season 3 or 2, Nick? Do you remember?
It was season 2.
Just type in Brett Shoemaker in the Investor Shed podcast. You'll see a sexy dude in a tank top on there. Click on that link, watch the episode. But Brett's a super knowledgeable guy, and we really thank him for coming on the show. Where can people find you? So how can people get a hold of you as well?
If you're trying to be friends, you can find me on Instagram, just my name. But if you're looking for like a loan, if you need a loan, investwithbrett.com. 2 T's, but you only pronounce the first one.
Yeah, the second one you get in trouble.
Investwithbrett.com. That's really close to Invest with Brit, isn't it?
I have no idea.
Isn't she the influencer?
Yeah, I don't think that's her website, though.
Oh, okay.
don't
Maybe
think
that's her
website's
handle
Invest with Brit.
somewhere. Isn't it Invest with Brit?
Investor Girl Brit.
Investor Girl Brit.
Yeah.
You should be Investor Girl Brit.
Investor Boy Brett.
Investor Boy Brit.
With 2 T's, but the first one is only pronounced. So
She's an
Yeah, you don't
influencer?
pronounce. Yeah, I think so.
Never heard of her.
Yeah, she's a bitch.
she's very nice. I had a nice conversation with her.
Her style and glitter is just obsessive.
Is she on the podcast?
Oh.
Not yet, not anymore.
Not anymore.
You might have burned that bridge.
Dude.
We're over an hour and nobody's listening. It's fine. Nobody's going to hear this.
Yeah, we talked about testicles and circumcision. So yeah, thank you so much for bringing that all up today. I do want to say that I've never actually exposed my balls to sunlight. So that must be a riveting experience. Never.
Wow.
I'm a ginger, man. I go out there and I just catch on fire. That's like the one part I don't want catching on fire because it's already redhead anyway.
Well, when you pee in public and stuff, you don't just give it a little flash to the sun?
You do a lot of...
I've got a little umbrella.
I'm going to go out and pee in public right now.
I was going to say, do you do a lot of peeing in public?
No. I mean, we pee after the shed. But that's all we do. This is going downhill quick, gentlemen. Thank you so much, Brett. We love you. Thanks so much for joining.
See you guys next week.
Downhill quick. Thank you so much for checking out the Investor Shed podcast. If you enjoyed your time, make sure to leave a 5-star rating and review on Apple Podcasts and Spotify. Follow along on YouTube, TikTok, and Instagram at The Investor Shed for shorts and promos about each episode. Do you want to be a guest or know someone who has great real estate investing advice and stories? Reach out to us at theinvestorshed@gmail.com.